Hey guys, Jared here. I just want to share with you in this video one of our common strategies that we use to structure retirees' underlying investments in their superannuation. It's called the bucket strategy, and it's a system to help you stress less in retirement. So what it is, the bucket strategy is an approach that, let's get this out of the way, separates your retirement savings, so your superannuation, into two distinct buckets within your super fund. So a lot of people don't realize that you've got multiple investment options in your super. You don't have to stay in the default option. You don't have to be in just one option. You can choose as many as you want. But what we want to do, we want to make sure that there's at least two distinct buckets, one for short-term needs and investments and the other for the long-term. So it helps retirees manage their portfolio to provide dependable income while being able to endure market ups and downs. So bucket one is the immediate financial buffer, and the rule of thumb, you might want around 5 years of your living costs that you're going to draw from your super over the next 5 years in this essential bucket. What assets do we use in there? So things like cash, obviously. Then we've got term deposits, fixed interest, so government bonds, corporate bonds, and credit funds. They're the type of safer assets that provide good, solid income. They don't come with the volatility that the share market comes with, essentially. And then bucket two is everything else. This is the growth bucket. So the long-term growth bucket consists of Aussie shares, global shares, and some property. So why don't we put it all in bucket one? Because we still need some exposure to growth buckets to ensure that your money continues to grow over time. You don't run out of money too quick. So we all know that there's going to be a market correction around the corner. A market crash, if you want to call it that, or a downturn, whether it drops 5% or 25%. There's always one around the corner, whether it's in 6 months' time or 6 years' time, nobody knows. And if they tell you that they know, they're lying. So what happens is when that market crash downturn occurs, you continue spending the money out of that short-term needs bucket, leaving bucket two alone, and you allow it to recover. Because what we know from market downturns is that markets always recover. To give you an idea, over history, this is the average amount of years it took for the market to recover after a significant drop. So all the way back to 1937, took 5.5 years, 1.5 years, 5, 2, 8, 4, 1.5, 6. Average all that out. 5 years is a very good rule of thumb. So 2008 global financial crisis, 4.6 years to recover. And this chart doesn't show the most recent one, which was the COVID crash, which rebounded very quickly. Didn't get all the way back to the top, but it was, you might say, 6 months. It made up most of its losses. So as long as we don't have to sell any shares, essentially, we've got stuff there ready to go to pay you your money to live off in retirement. That's how we endure the market's ups and downs. If you have it all in one bucket, like most people do, you're forced to sell those shares. So for those still watching, I just want to give you a bit of a case study of this risk in play, in real life. And the actual risk that we're referring to is called sequencing risk. Now, bear with me while I'll give you two scenarios. This is scenario one, where we've got two people in there over 11 years. You'll see on the left here all the way down to 11 years. They both start with $350,000. And in year one, you'll see that this person got a 3% return and then negative 25, negative 10, and so on, and with an average return of 5% over those 11 years. Investor B, they get the same returns as investor A, but in reverse order. So you'll see here, year 1, 3%, year 11, 3%, year 2, negative 25, the second last year, negative 25. So it's just flipped it around. So the average return, because it's exactly the same basically, but in different years, the rule of averages, it's 5% still. Now these guys, as this scenario suggests, aren't retired, so not withdrawing out any money from their balances to pay their living costs. They're still working. So the difference between the two portfolios at the end of 11 years, as you'll see down here in the bottom right corner, is $0. It makes no difference when you're not retired. But let's change one thing. Let's take this exact same scenario and put it in the retired column, and they're drawing out $35,000, $25,000 every year. So the returns are exactly the same. 3% in the first year, then negative 25, negative 10. Investor B gets those same returns in reverse order. However, because they're pulling money out, the difference in the two portfolios after 11 years is $169,000. Same returns, both 5%, but a very large difference in the amount of money they have left, because investor A got the bad returns at the start, investor B got them at the end. So it's sequencing risk is getting the bad returns at the start of your investment journey, and the two-bucket strategy doesn't mitigate the risk entirely, but it certainly helps reduce it. So that's the bucket strategy. Hopefully that's been of value. Thanks.